Hi friends, in this video I am going to analyze 3 stocks that have specific tailwinds for the short term duration, let's say 6 months to 12 months of time. Throughout this video I'll try to also share with you some investing tips, and my intent to create this video is not to give you stock recommendation, but by using practical examples I will also teach you few very good investing principles in this video. People who don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get to stock number 1, and the stock number 1 is HFCL Limited, which is Himachal Futuristic Communication Limited. It's a telecom company. Immediate question might be, Rahul, why are we talking about telecom companies all of a sudden? Because have a look at this data and you will see that this is the FI's investment in the last 6 months by sector. You find this data on NSE website, but the point here is that the 3 sectors that you see, one is FMCG, second is healthcare, and third is telecom. In the last 6 weeks at the time of recording this video, they have been seeing massive investments by the FIIs consistently. 1st August to 15th August, 16th August to 30th August, 1st to 15th September, all these 6 weeks that you see, FMCG have seen a lot of movement by the FIIs, healthcare has seen good movement, and likewise telecoms have seen some good investment by FIIs, and specifically last 2 weeks they have ramped up their investments. Now I don't know whether this will continue or not, but the point is that telecom sector is right now seeing a lot of investment by FIIs, and I'll also speak about why that is happening. That is why I am talking about one of the stocks that is from telecom sector. Okay, Rahul, we understood this point, but why HFCL Limited? So there are 4 to 5 hypercritical points about this stock. That's why I'm analyzing it. First point is that recently, if you look at my screen, you will see that in the month of June 2024, European Union had proposed anti-dumping duty for almost 10 telecom companies that are exporting products from India to Europe. And there is only one Indian telecom company, that is HFCL, which was exempt from this duty because they were following the fair practices as per the EU, and the remaining 10 companies were simply dumping the products into EU. That's why EU had proposed a levy of around 11.4%, ruining their business. So the point here is that HFCL has been following some fair business practices, and I like companies that follow some fair business practices. Point number 2 is that just yesterday HFCL stock rallied by around 6% intraday, although it lost the gains during the day, and this rally was driven on the back of another important news that the company has signed a strategic partnership with a company called General Atomics in US, and HFCL is going to supply critical subsystems for advanced unmanned aircraft systems. So basically HFCL is now diversifying into defense sector, and they have done this strategic partnership with a US based company. Although HFCL is a telecom company, they are slowly moving into defense area as well. As you can see that they are developing a state of the art drone detection radar that could be a game changer in the defense sector in my view. Hypercritical point number 3 is their order book. Have a look at my screen. You will see that the company right now is sitting at an order book of 6,700 crore. And to put this in some context, last year the company did revenues of 4,500 crore. So their order book is almost 1.5 times their annual revenue run rate. So that's a good visibility in terms of revenue for the next 1.5 years. Since we are on the subject of order book, also please be aware that a company called BharatNet recently issued a tender of 60,000 crores. And what the HFCL's management is saying is that out of the 60,000 crores, around 5,000 to 6,000 crore could be the order for optical fiber cables. And HFCL has also bid for this particular order, and they are the largest optical fiber cable company in the India. And if they win this order, then it is going to be a huge order for them, almost 1.5 times of their yearly revenue if they win this order. And if and when they win this order, and if this comes into news, in my view, the stock might see some positive movement, because if the stock has been hitting some positive news in the last 6 to 8 months, then it comes into the radar of big investors. Okay, Rahul, we get your point in terms of the short-term investments. What about the company's track record of fundamentals? So if I look at the P&L account of this company, you will very quickly note that the top line has been very flat in the last 3 to 4 years. In terms of the profit, yes, there is some growth here, but I don't think it's a very good growth rate that the company has achieved in the last 4 to 5 years. But please understand, past history is past. If I speak about the future of this company, the management is right now guiding for 25% to 30% of revenue growth in the next year. And if you look at the FY26 and 27, company is guiding somewhere around 20 to 30% of growth. In my view, that is a very decent growth for a company that has not grown at this rate in the last 4 to 5 years. Also, if if you look at the slightly medium term view, let's say 3 years from now on, the company is projecting that their revenues are going to be somewhere around 9,000 to 10,000 crores. ROCE is going to be up from 13% to almost 20% or slightly more than 20%. So the very important investing principle that I wanted to drive home here is that not necessarily the past history is what is going to drive the future prices of the stock. It is extremely important for us to look at the future earning projections of the company. Whether they are right or wrong, we don't know the future, but at least we have done the analysis about where the company is heading in terms of the revenue growth, profit growth, ROCE, some important metrics that are going to tell us whether the stock is going to do good in the future or not. And such deep analysis is what I share on a daily basis on my YouTube member community. If you are not yet a member, consider becoming a YouTube member. Simply go to my channel, press on the join button and follow the instructions. The feedback has been really good so far. Coming back to HFCL, Rahul, are there any particular risks that we need to be aware? Yes, so if you read the commentary of their Q1 25, what the management is saying is that right now there is a temporary slowdown in the optical fiber cable demand, and that is likely to pick up only in the Q3 or Q4. But to be honest, this information investors already know about, so it's not something new. But my point is that you really need to be prepared for some slowness in their revenue or profitability in Q2, but in Q3 and Q4 they are likely to see some recovery. Second thing also you will note is that if you look at their shareholding pattern, you will see that their promoters have pledged around 44% of their shares, but this is a misnomer. This is not right information, because when I was digging deeper into the company's management commentary, what one of their director has said that this is a wrong information. What the directors have actually done is that they have done a non-disposable undertaking to the financial institution, meaning that they are not going to dispose these stocks, and that's the undertaking they have done. They have not done the pledging of their shares to take loan against the company. So please understand that this is a incorrect information. Right now the stock exchanges do not have any meaningful bucket to classify non-disposable undertaking versus the pledging of the shares. I hope this point is also very clear to you. Okay Rahul, is there any other risk that you see? Other risk that I see is that the stock is trading at all-time high and there is always a chance of correction. So I never generally buy any stock at an all-time high price. So something that you need to be aware of. If you look at the valuations of this company very quickly, you will see that the company is trading at a PE of 62, which is slightly on the higher side. If you look at the chart here, and if you look at the PB ratio, it is at 5.91. PEG ratio is also on the higher side, 7.59. So in my view, this is slightly overvalued right now, but I see the massive tailwinds that I've described in the beginning of that. That is why maybe investors are willing to pay this premium. And the question is that, are you willing to take that high risk for paying this premium valuation for this particular company or not? So I've given you a lot of critical analysis of this particular stock. I've given you the reasoning behind it. It's not a stock recommendation, but please do some more analysis about this company and let me know your thoughts in the comments. With that, let's move to stock number 2. So far, if you're liking this video, please hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, the stock number 2 is Birlasoft Limited, a company that made a highs of 861 back in February 2024. It has come down to now 630 level at the time of recording this video, which is almost a 26% drawdown from its all-time high value. And one of the key reasons of the stock falling or correcting was mainly that their Q1 25 results was not very good. Investors did not like that result. In fact, I posted a lot of details about Birlasoft Limited on my YouTube member community, giving a lot of details in a very timely manner so that people can go and understand what is happening with the company. But the reason I included Birlasoft in this particular video is that if you read this commentary, you will note that what their management is saying is that discretionary spending by their clients, by their customers has been tightened very recently, meaning that the customers are not spending money on discretionary IT requirements, which are nice to have features where they don't need to spend money. Because right now, if you look at what has been happening in the last 6 to 12 months is that the borrowing rates in US have been very high, and therefore the companies have been very meticulous in terms of spending their money on some things that are discretionary, which are nice to have, which are not needed to run their business as usual. And now comes the hypercritical point that very recently the US Fed have cut the rates by 50 basis points. Meaning what? That the borrowing in US will become easier now, hopefully, and in the next 6 to 12 months they might go for one more rate cut or 2 more rate cuts, that we don't know, but eventually the rates will come down. What will that mean is that companies in US will be able to borrow money at a much cheaper rate, and then they're likely to spend that money into discretionary spending that they have been holding on to. And guess what? Birlasoft Limited gets 84% of their revenues coming from America, so the US Fed rate reduction in the next 6 to 12 months is likely to help stocks like Birlasoft because A, their 84% of business is coming from Americas, and point number 2 is that they are heavily relying on the discretionary spending, and the discretionary spending go up when the US Fed rates come down. Okay, Rahul, we understand that, but what about the Q1 results that the company delivered? They were bad results. Yes, of course, but what the company is now saying is that the Q2 is going to be stronger than Q1. So they are likely to be on the path of recovery. And of course, the reduction in the US Fed rate is likely to help them win more deals in my view. And that's why I thought I'll include this in this video. Again, without going deep dive into their business models and things like that, what I really want to look at is the last point, which is the valuation. If you look at the valuation, the PE ratio of this company is now 27 versus industry PE of 39. PB is 5.68 versus 3.8 now. It is the lowest in all other peers that you see here, and also from a PEG ratio perspective 1.50, so it is almost lowest. I think only after KPIT this is number 2. If you look at the PE ratio in the last 1 year, you will very quickly note the median PE has been 37. Right now the company is trading at around 27, and if you look at the PB ratio in the last 1 year, the median PB has been 6.9. Right now the company is trading well below that median PB ratio, which is 5.7. Any risk that I see in this stock? Right now, if you see, the stock is trading at around 628. It is entirely possible that the stock might move sideways or it might come down, but I see a strong support at around 565 rupees level, and also the second level support will be at 549. Request you to please not take this as a stock recommendation. The only reason I included Birlasoft is so that you understand the link between Fed rate cuts and how that may impact IT stocks which are relying on the discretionary spending. Important logic that you need to really stick in your mind. With that, let's move to stock number 3 now. The third stock is from NBFC sector, a company called Aptus Value Housing Finance India Limited. And the reason I'm speaking about NBFCs right now is that in my view, in the next 12 months, NBFCs are going to do much better than even banks. This is because RBI is likely to cut the rates by 25 basis, is there in the news as well. And generally when the US Fed cuts the rate, RBI is likely to follow, albeit later than 1 to 2 months. Now, whenever RBI will cut the repo rates, then NBFCs are likely to be at a more advantageous position than banks. This is mainly because NBFCs borrow a lot of money at a higher interest rate than banks. Generally, that's what happens. And when the repo rate comes down, the borrowing cost of NBFCs are likely to come down, and therefore either their NIMs, which is the net interest margin, is going to go up, or they're going to pass on this savings to the customers. Either ways, depending on how the NBFCs really work. But please understand a very important point, that not all NBFCs are likely to see impact on their net interest margin, their profitability in the same manner. This is extremely important point, and that's why I have picked up example of Aptus as a stock. Have a look at my screen. You will see that Aptus has given around 80% of their loans at a fixed interest rate. What does this simply mean? That no matter what happens to the repo rate cuts, they are going to get this interest rate from the customers, which is 80% of their portfolio. So they don't need to reduce their interest rate that they've given the loans to the customers, right? On the other side, if you look at the borrowing profile of this Aptus, so the Aptus company borrows money from, let's say, banks and using commercial papers or from equity. If you look at their profile, you will see that 42% is the equity stake, right? That's fine. They are not paying any interest on that. But if you see the remaining 56% or 58% here, 50% of that is fixed and remaining 50% is floating. So this 28.97% of their borrowing is likely to see reduction in the interest cost that they're paying, because the repo rate will come down, and naturally this interest rate at which they have taken these loans will also come down, and therefore their liability will reduce, but they will continue to enjoy 80% of their portfolio being paid at the interest rate that they've already agreed with customers. So the point here is that you need to go for NBFCs that have a high proportion of their loans given to customers at a fixed rate, not at floating rates, because if it is floating rates, the moment RBI cuts the repo rate, they will also have to reduce their interest rates. And in this case, here 80% of the loan, they don't need to do that. They will still enjoy the high interest rate that they've agreed with the customers already. While at the liability side or the borrowing side, if you see, they are going to get benefited from this repo rate cut. So this is a win-win situation for stocks like Aptus Value Housing Finance. That's why I've picked up this example. And that's why precisely in the last 1 week, since the time the Fed has reduced the rates, the stock has been making some rallies here. You can see the last 3 to 4 days of these rallies here because of the reason that I explained to you. Investors who understand this domain, they understand the impact of Fed rate cuts, properly go and analyze the NBFCs that they need to pick on. And if you liked my analysis, hit the like button. Let me know in the comments a simple thank you. It will motivate me to do some deep analysis for you at zero cost. And also, if you're not a YouTube member, please consider signing up for the YouTube member community. You're going to learn something like this at a very, very deep level. Now, if you look at the valuation of this company, this is trading at a PE of 28 versus 21 industry PE. The PB is at 4.95. And the industry PB is at 2.82. But look at the PEG ratio of this company, right? It is very, very low. Again, that is why the company is growing at a much higher rate and investors are willing to pay this premium, which is higher than the industry PE. Also, let me give you 30-second commentary about their past history of the track record. And if you look at my screen, you will see that in the last 5 years, they have grown at a 30% CAGR, massive growth in the last 5 years. If you look at the last few years growth in terms of their NIMs, they have grown by net interest margin, they have grown by 32%. Their profit after tax has grown by 30%. ROE has been very, very good if you see 18.13% as of Q1 2025. If I talk about return on assets, the most sought number when it comes to banks and NBFCs, it is 7.73%. Just to put this in some context, SBI's return on assets is at around 1%, right? So imagine this company is generating 7 times more return on asset than banks like SBI. Also look at the net interest margin percentage, which is 12.80%. Again, put this in some context for you. For example, HDFC Bank runs at a NIM of around 3.5%, not more than that. If you look at their loan portfolio very, very quickly, majority of their loans are secured portfolio, mainly into home loan or quasi home loans. So pretty much secured loans is what they are offering. If we talk about the bad debt or NPAs, have a look at my screen. Gross NPAs are well below 2%, 1.3% right now. Net NPAs are also well below 1%. So the asset quality is also very, very good right now. Okay, Rahul, understood. Is there any risk in this particular stock? So in my view, in the last 3 to 4 trading sessions, the stock have given very, very good rally. It might move sideways or might have some short-term correction in the next 1 to 2 weeks. I can't really predict it, but overall I have explained to you the logic that there is a tailwind here because of RBI's intervention in terms of cutting the repo rate will definitely help this company in my view. In terms of the profitability, I can't speak about the stock prices in general. With that, I hope you understood the analysis that I have done about these 3 stocks. If there are any questions, let me know in the comments, and if you enjoyed this video, hit the like button. Let me know in the comments a simple thank you, and I'll see you in my next video. Until then, keep rocking.